2-1 buydowns was one of the most dangerous mortgage fads of the recent mortgage era. Quite frankly, so many buyers that purchase are underwater now. So, what is a 2-1 buydown, first of all? A 2-1 buydown is essentially a simple loan that you would get. It's essentially an ARM loan, but it's an ARM loan on the front end, is kind of what I like to compare it to. So, let's say a seller comes along and they're selling a property, cannot move the property, and the buyer comes along and they want to buy this property. They really like the house, but may not necessarily be able to afford it right away. The seller then could afford or offer to pay what's called a 2-1 buy down, which it temporarily buys down the rate for the buyer so that they can qualify for the property. So let's say the interest rates at the time were about 7%. What will end up happening is the seller will pay for a 3% buy down, and what that would entail is in the first year the mortgage rate would be 5%. The second year, it would go up to 6%. And the third year, it would go back to 7%. Now, it was something that was sold so that people could then refinance. They were expecting a massive drop in the interest rates. So they were sold that they were going to be able to refinance in about 6 months or a year, which would not be a problem. Now, that is obviously a massive issue because about 7.6% of homes funded, at around December of 2022, it was actually 2-1 buy downs. They had a 2-1 buy down, which is a massive amount of loan, right? So it started tapering off in June of 2023. But basically, the share of all those loans, buy down points, climbed to about 3.1% in 2024. And the share of all loans with buy down points climbed to about almost like 8% of 2025 borrowers used ARM loans or some form of buy down kind of option, a temporary buy down loan. So imagine that 8% of 2025 borrowers, which was just last year, used an ARM loan or a 2-1 buy down, which is, again, a massive amount of people. An ARM loan is an adjustable rate mortgage. So just like the 2-1 buy down, it is also adjustable. So the markets that it was most popular in were Colorado, Utah, Arizona, Idaho, sort of like the Midwestern market. Now, what the 2-1 buy downs did, which makes me sort of get fired up, is it masked a real affordability crisis. So on a $500,000 loan, a 7% rate means that mortgage would have been about $3,300. 6%, it would bring it down to $3,000 even, and a 5% interest rate, you would see it at $2,680. So it was an initial savings about $330 to about $650 a month, which looked appealing for buyers who signed up for this. But they didn't account for the rate rising up because, again, they were told that, hey, listen, you're going to be able to, mortgage rates are going to be at 5% in the next year or so you could just refinance. Now, borrowers with buy downs pay about 15 basis points higher for their note rates. So if they don't refinance, they could actually pay more for their house in the long run, which makes sense, right? Because if you pay a higher interest rate, you're going to pay more money for the property. The issue too is that lenders then still qualify these buyers at a lower rate, which meant that let's say you didn't qualify for that property, that $500,000 loan at 7%, you could do a 2-1 buy down, and some lenders, not all of them, qualified that buyer at a 5% interest rate, which meant that their maximum debt to income ratio was about $2,600.80, right, per month, and they were qualified on that number versus the higher 7% number. So basically, by early 2026, mortgage rates were still around 6%. So again, many people who expected to refinance at that time were not able to. They were unable to. Again, massive issue as we go into this year. I'm kind of, just I don't want to say excited, but I'm just really interested in seeing where this goes and where the mortgage industry goes because of this. Again, because quite a bit of loans were done using an ARM loan or something of similar. Now, the people that are probably the most guilty of using a 2-1 buy downs other than realtors, which, full disclosure, I was against it in the beginning because I didn't believe that interest rates were going to drop as fast as possible. I didn't think it was. It was an option that was on the table. A lot of people discussed it, but my solution to the problem was use the money to do a permanent buy down, not a 2-1 buy down, just do a permanent buy down. So according to National Association of Home Builders, 65% of new home sales in September 2025 use incentives like the 2-1 buy down, and about 39% of builders cut prices by only 5%. So what they were doing as builders was they were not cutting their prices because that also keeps their shareholders happy, and it keeps them making more fees, and keeps their numbers looking well. Because if the market improves, you couldn't sell to a new buyer. If you recently just sold a house for $30,000 less, you couldn't sell them the same house for the price it is today. So it's very easy to move a price up on a house by 1 or 2% and continue on and take away that incentive, but you show the market that you have had higher or continuing trending up more sales on your new home community. So then that would allow you to continue to move on with your next phase of the construction as the market improves. And in most markets, the market are improving because it's always been an inventory issue. It's just also, we're seeing that the true affordability now is coming head to head with that. And I'm very curious to know where that is going to go. So again, instead of reducing the home prices, these home builders then basically offered incentives. They threw incentives at people. And I had a lot of buyers that got tons of incentives. They would get, $30,000 at the design center, plus they will pay all their closing costs if you go with my lender. So again, buyers paid more for the house, but received a short-term discount, quote unquote, because we all know how builders make money. But in many markets, pretty much almost all the builders use markdowns on mortgage rates to help sell homes. So what's happening though right now is, like I was hinted at before, is the aftermath of this, right? So the payment shock, the negative equity, and the delinquencies. And I actually have a client of mine that reached out to me who I actually did not represent her in purchasing this home, but she was referred by a friend, and she's in quite a lot of this category right now because she is unable to pay her mortgage because it rose 2%. And again, a lot of people spend their money all the way up to the maximum that they can. They live paycheck to paycheck, and they're fine with it because a lot of people have, very cushy jobs, and they know that they're going to be gainfully employed, so they're okay with living paycheck to paycheck. So according to Q3 equity data, about 1.2 million homeowners were underwater. So that's about 2.2% of our market, and which was a 21% year over year increase. So the average homeowner lost about $13,000 in equity. So, for instance, in Florida, where the insurance prices obviously hurt those values, in Asheville, now insurance prices are going to hurt your value because your value of your property is being diminished by the cost of insurance. Because insurance costs are going up, is making it harder for buyers to be able to purchase those properties. So, basically, 1 in 4 seriously delinquent loans will be in negative equity if sold at re-owned prices. So basically, if a house is in a significant re-owned condition, basically 1 in 4 of them would have to have a short sale where they're not going to have enough equity to be able to pay the realtors and pay the banks back, especially if people got second mortgages. So where did that leave us, right? So the other thing too I will add is FHA delinquencies were higher than pretty much any other category, which shows that generally people that get an FHA loan, it's because of a credit issue. Maybe they don't have as high of a credit in the 700s. So people, and then also higher debt to income ratios. The one thing I will say is there was about 11%, just over 11% of FHA delinquencies, which was the highest since 2021. And a lot of them are actually in later stage delinquencies, which means that they're 90 plus days in an increase, which about 76%, right? That first time and lower income buyers often use those FHA loans and VA loans like I said, and so they're more vulnerable to payment shocks because those are the people that are generally going to be living paycheck to paycheck. Don't get me wrong, there are some anomalies. I've seen some very wealthy people and people that make a ton of money that live paycheck to paycheck, but those are sort of like an anomaly in a way, even though it's still quite a bit of America. So the issue here then becomes you cannot refinance, right? So now you're delinquent on your loan, and now you're also, if you were to refinance, the rates are higher. So technically, your debt to income ratio doesn't align with the criteria because interest rates today are about 5.5%. But if you qualified for a loan at 5%, you at the maximum of your debt to income ratio, your debt to income ratio right now will be too high for you to be able to do a new loan. So you're kind of stuck between a rock and a hard place. You may have to get a second job or do something to figure out to pay your mortgage, and you may have to sell your house. Now, I always educate my buyers on this, but you should always buy responsibly. A lot of people tell you, hey, like I could get you a lower rate and it's temporary. I don't get me wrong. I don't. There are specific instances when I recommend an ARM loan, but it's to a very set criteria of a person. I know their finances. I know the type of work that they're in. A lot of times, actually, 7-year ARM loans work well for doctors who are well into their residency, who I know are going to pay off their mortgages in 5 years. So a lot of times I will recommend an ARM loan because they get a lower interest rate and I know they're going to pay off their mortgage. So you have to learn how to buy responsibly. And one of the things I tell my buyers is you have to account for the worst case scenario. What if you're, one, not able to refinance, and two, what if your ARM loan then goes up to 8%? What if your 2-1 buydown loan goes up to 8%? I'm not saying it will, but here we are, and most people's rates are at 7% who bought, in 2020, 2022, 2023, right? So that was an issue. Now, if you need to buy now, plan a long-term hold. So this person that purchased a home about a year ago that got the 2-1 buydown, I basically told her, hey, look, it's not a good time to sell your house. You need to hold on to the property and then maybe look at selling in the next year or two, because you have to hold on to the property if you are going to buy now. The other thing too is, consider alternative strategies like larger down payments or smaller homes or waiting for price corrections. Quite frankly, I don't believe there will be any massive price corrections, especially in the DMV market. I'm speaking for this market because we are well protected and well insulated with the government and military bases around. So, what you could do is you could maybe ask about seller financing. And these are all things that we talk about with our home buyers, especially like our investor savvy ones. So essentially, a mortgage shouldn't be a marketing gimmick, and I don't believe in that. There are tons of loan sharks out there, and if the full rate isn't affordable to you, you should not buy. You should not truly buy a house. Do not use a 2-1 buy down because, again, you might be in a similar situation, and where a lot of experts are looking at the markets, yes, interest rates could drop, but you have to be prepared for the worst case scenario, is what I tell people. So don't gamble on what you cannot control. Do you control mortgage rates? More than likely, if you're watching this video, you don't control mortgage rates, and you probably shouldn't be buying if you need to do a 2-1 buy down. I highly recommend doing a permanent buy down if you are going to do any sort of buy down. That way you know where it's going to be. I also personally believe that a 2-1 buy down was just a waste of money. It was just adding money into the pockets of bankers who were selling these 2-1 buy downs because it didn't give you any real benefit. Just do the permanent buy down. It would have been a lot better off right now. And I'm sorry to the people that are struggling right now because of it. If you need some help, counseling, I'm happy to help. Send us a DM, hit that subscribe button below, and I'll see you on the next one. Take care.